Every year, thousands of families face what feels like the ultimate financial nightmare: foreclosure. It's an unstoppable disaster of certified letters, stressful phone calls, and sleepless nights. It feels like you're in a deep hole and someone keeps handing you a bigger shovel. I know that feeling. I still remember being a kid and losing our family home. I've been there. The stress, the uncertainty, the walls closing in. It's a heavy, heavy weight. But what if I told you this isn't the end of the road? What if there's a clear path to stopping it, with options backed by the full faith and credit of the United States government? The truth is, there is. This isn't some secret playbook for the rich and powerful. Fannie Mae and Freddie Mac, the giants of the mortgage world, help thousands upon thousands of homeowners avoid this disaster every single month through what are called loss mitigation programs. For example, in October 2025, they completed over 17,000 of these actions. That's a stadium full of people who are on the brink, just like you might be, who found a way out. In this video, I'm going to walk you through the exact 2026 government-backed programs and proven strategies that can help you keep your home and, most importantly, stop losing money. And we're not just talking about foreclosure, we're talking about the hidden equity drains, the silent wealth killers that affect homeowners every single day. My name is Jack, and I'm a recovering investment banker turned real estate agent. Over the past 15 years, I've sold more than 1,000 houses, and believe me, I've seen it all. I've worked with families on the verge of losing everything and helped them navigate this exact maze. I've also helped countless others build and protect their hard-earned equity. My goal here is simple: to give you the playbook, the step-by-step guide to take back control. So, let's get started. Before we get to the solutions, we need to get real about what the landscape looks like right now in 2026. The word foreclosure probably conjures up images from the 2008 crisis, with entire neighborhoods plastered in auction signs. Today's situation is different, and in some ways, it's a lot sneakier. The data from early 2026 shows a trend we can't ignore. Foreclosure filings are up. In January 2026, over 40,534 U.S. properties had a foreclosure filing. That's a 32% jump from just 1 year ago. This isn't a tidal wave, but it's a steady rising tide. For the 11th straight month, the numbers have been climbing year over year. Foreclosure starts, that first scary notice a homeowner gets, are up 26% from a year ago, and the number of homes repossessed by lenders has surged by a staggering 59%. What's going on? It's a mix of things. For some, it's the financial hangover from the pandemic. For others, it's the rising cost of living. Property taxes, insurance, and groceries are squeezing family budgets dry. This pressure is hitting certain areas harder than others. States like Delaware, Nevada, and Florida are seeing some of the highest foreclosure rates right now. But this isn't just a state-level issue. It's happening in pockets all over the country. Now, here's what most people miss. The most dangerous part of a foreclosure isn't just losing your house. That's the final blow. The real damage, the thing that follows you for years, is the catastrophic loss of your equity and the absolute destruction of your credit. Think about it. You might have spent a decade paying your mortgage, building up tens or even hundreds of thousands of dollars in home equity. That's your wealth, your family's financial security. Foreclosure doesn't just take your home, it vaporizes that wealth. The bank takes the house, sells it at a discount auction, pays off the loan, and if there's anything left, which there often isn't, you might see a check. But usually, you walk away with nothing. Then comes your credit score. A foreclosure can stain your credit report for 7 years, and it's like a financial scarlet letter. It can tank your score by 100 points or more, making it incredibly difficult and expensive to get another mortgage, a car loan, or even a credit card. This is why stopping the loss is so critical. We're not just saving a building, we're saving your financial future. The good news is, the system has more safety nets than ever. Lenders and the government know that foreclosure is a lose-lose situation. It costs them a fortune, and it's devastating for you. That's exactly why the programs we're about to discuss exist. They're designed to be off-ramps from the highway to financial disaster. Understanding this is your first step to taking back power. You are not a passive victim here. You have rights, and you have options. The moment you miss that first mortgage payment, a clock starts ticking. This initial period, roughly the first 30 to 45 days, is without a doubt the most crucial window you have to change the entire outcome. What you do here, or what you don't do, sets the stage for everything. The single biggest mistake people make at this stage is silence. It's born out of fear, shame, or just feeling completely overwhelmed. You see the unopened letters from the bank piling up, you ignore the calls from unknown numbers, and you just hope it'll all go away. This is the worst thing you can do. It's like being in a hole and deciding to cover your eyes instead of looking for a ladder. Let's flip the script for a second. From the lender's perspective, they have to follow a strict set of rules. After you're delinquent, your mortgage servicer is legally required to try and contact you. By law, they have to give you written information about your options to fix the problem within 45 days. They're also often required to give you a single point of contact, a specific person or team dedicated to your case. This isn't just a formality, it's your lifeline. Step 1, and I can't say this enough, open the mail, answer the phone, communicate. Your first call should be to your mortgage servicer. But when you call, you need to be ready. This isn't the time for wishful thinking, it's time for facts. So, step 2 is to get your documents in order. You need to create a financial snapshot of your situation. This usually includes proof of income, recent pay stubs, a letter from your employer, or if you're self-employed, your last 2 years of tax returns and a current profit and loss statement. A list of your monthly bills, car payments, credit cards, student loans, everything you owe each month. A hardship letter. This is a simple, honest explanation of what happened. Did you lose your job? Have a medical emergency? Go through a divorce? You don't need to write a novel, just a clear, concise paragraph explaining why you fell behind. While you're gathering that, there's another call you need to make immediately to a HUD-approved housing counselor. This is probably the most powerful and underused free resource in the country. The U.S. Department of Housing and Urban Development, HUD, funds nonprofits to give free or low-cost advice to homeowners. These people are experts. They know the laws in your state. They know the programs you qualify for. And they can even negotiate with your lender for you. You can find a counselor by calling HUD's hotline at 800-569-4287 or by searching on the HUD website. A quick word of warning. Watch out for scams. You'll see ads online from companies promising to save your home for a big upfront fee. Never, ever pay anyone for this kind of help. Your servicer and a HUD-approved counselor will give you this assistance for free. The goal in these first 45 days is to get ahead of the process. Federal law is on your side here. A lender generally can't even start the formal foreclosure process until you're more than 120 days delinquent. That 120-day period is a gift. It's the time you have to work with your servicer and counselor to find a solution. By taking these steps, talking to your lender, gathering your documents, and calling a HUD counselor, you change the entire dynamic. You're no longer just someone who's behind on payments. You're an active participant working in good faith. That makes it so much more likely that your lender will work with you on one of the powerful options we're about to cover. Alright, let's get into your options. If your goal is to stay in your home, there's a whole menu of what are called retention options designed to make that happen. These aren't loopholes. They are structured, government-supported programs. They exist because it's better for everyone, you, the lender, and the economy if you can keep your home. These programs are primarily for government-backed loans from FHA, VA, Fannie Mae, and Freddie Mac, which make up most of the mortgages in the US. Let's walk through them from simplest to most powerful. Option 1, reinstatement. This one's the most straightforward. Reinstatement just means you pay the entire past due amount plus any late fees in one lump sum. You do that, your loan is current, and you go back to making your normal payments like nothing happened. This is really only an option if you had a very short-term problem. Maybe you were between jobs for a month, and you now have the cash to catch up. For most people in a serious crisis, that's not realistic, which leads us to the next option. Option 2, the repayment plan. A repayment plan is the next step up. Let's say you're 3 months behind on a $2,000 mortgage, so you owe $6,000. With a repayment plan, your servicer might agree to spread that $6,000 out over 6 months. They'll just add an extra $1,000 to your regular mortgage payment. So for the next 6 months, you'd pay $3,000. After that, you're caught up and your payment goes back to the normal $2,000. This is a great tool if your income is stable again, but you just don't have a $6,000 lump sum lying around. But you have to be brutally honest with your budget. Can you really afford that higher payment for 6 months? If not, you'll end up right back where you started. This is where that budget you create with your HUD counselor is so important. You have to know your numbers cold. Option 3, forbearance. You probably heard this word a lot during the pandemic. Forbearance is when your lender agrees to temporarily reduce or, more often, completely pause your mortgage payments for a set period. It's designed for when your financial hardship is serious but temporary. For example, you got laid off but have good job prospects, or you have a short-term medical issue. The key word here is temporary. Forbearance doesn't erase the debt, it just kicks the can down the road. The missed payments have to be paid back. How they get paid back is the critical part. In the past, some lenders would demand a giant lump sum at the end, which was impossible for most people. Thankfully, the rules have changed. Now, the missed amount can often be moved to the back of your loan in what's called a deferral. This means you don't have to pay it back until you sell the house, refinance, or pay off the loan years from now. This is a huge relief that lets people get back on their feet without a payment shock. To give you some context, recent data from late 2025 showed tens of thousands of loans in forbearance plans, showing just how common this tool is. Option 4, the loan modification, the game changer. This is the most powerful tool in the entire arsenal for keeping your home. A loan modification permanently changes the terms of your mortgage to make your payments more affordable. This isn't a new loan, it's a permanent adjustment of your existing one. Loan modifications are the reason why millions of families have been able to stay in their homes. Since 2008, Fannie Mae and Freddie Mac have completed over 7.2 million of these foreclosure prevention actions. A modification works in a few ways, usually in a specific order, to get your payment down to a manageable level. Add the past due amount to the balance. First, they take everything you owe, missed payments, fees, and roll it into your principal loan balance. Your loan is instantly current and the foreclosure clock stops. Reduce the interest rate. Next, they can lower your interest rate to the current market rate, or sometimes even lower. This can have a huge impact on your monthly payment. Extend the loan term. If that's still not enough, they can extend the life of your loan. If you have 20 years left, they might stretch it back out to 30 or even 40 years. Yes, you'll pay for longer, but it can dramatically reduce your monthly payment. In fact, reports from late 2025 showed that about a third of all modifications were term extensions. Forbear some of the principal. In some cases, mostly with FHA loans, if your payment is still not affordable, they might set aside a portion of your principal balance. This part of the loan just sits there, not accruing interest until you sell or refinance. The goal of a modification is to get your total housing payment down to a target percentage of your gross monthly income, usually around 31%. This is what makes it a sustainable, long-term fix. It's not a band-aid, it's a solution based on what you can actually afford. Navigating this can feel complicated, which is why, and I'm going to sound like a broken record here, you need to work with a HUD-approved housing counselor. They'll help you with the paperwork and make sure you're being evaluated for every option you're entitled to. These programs are your right, and they are the most effective way to stop the loss and stay in your home. Look, sometimes staying in the home just isn't in the cards. Maybe the job loss is permanent, or the numbers just don't work even with a loan modification. That's a tough pill to swallow. But in these situations, the goal shifts from saving the house to protecting your financial future. Losing your home is painful, but it doesn't have to mean financial ruin. The fastest way to lose everything is to let the bank take the home in a foreclosure. An auction is a fire sale that torches your equity and your credit. That's why there are options for a more graceful exit. They're designed to avoid the damage of a formal foreclosure and help you land on your feet. Option 1, the pre-foreclosure sale, aka a short sale. A short sale is when you sell your home for less than what you owe on the mortgage, and the lender agrees to accept that lower amount as payment in full. This is a common solution when you're underwater, meaning your home is worth less than your loan balance. Here's an example. You owe $300,000 on your mortgage, but the market has dropped and your house is now only worth $270,000. You find a buyer willing to pay that price. You take that offer to your lender along with your hardship info. If they approve it, they accept the $270,000 and forgive the remaining $30,000 you owed. Why would a bank do this? Because it saves them money. A full foreclosure is a long, expensive headache for them, costing tens of thousands in legal fees. A short sale is faster and results in a smaller loss. For you, the benefit is huge. While a short sale isn't great for your credit, it is far less damaging than a foreclosure. Even better, that forgiven $30,000 is generally not considered taxable income on a primary residence. Some programs even offer a few $1,000s in relocation assistance to help you move. I know this is a lot of heavy information, and it can feel overwhelming, but I hope you're starting to see that you have way more power in the situation than you probably thought. If you're finding this valuable, do me a favor and click that subscribe button. My whole goal is to give homeowners like you the knowledge to build and protect your wealth. By subscribing, you won't miss any of my future videos on everything from navigating the market to making smart financial moves for your family. Option 2, deed in lieu of foreclosure. This is usually the last stop before a foreclosure auction. A deed in lieu, or DIL, is exactly what it sounds like. You voluntarily sign the deed to your house back over to the lender. In return, they release you from the mortgage debt and cancel the foreclosure. To qualify for a DIL, you usually have to try a short sale first. Lenders want to see that you made a real effort to sell the property. If you can't find a buyer after a few months, they might then agree to a DIL. The main advantage here is speed and finality. It brings a very stressful process to a clean end. You hand over the keys and walk away. Like a short sale, this is much less damaging to your credit than a foreclosure, and it gives you a sense of closure and dignity you don't get from being forced out. You may also be eligible for relocation money here too. The one catch is that the property has to have a clean title. If you have a second mortgage or other liens on the property, the lender will probably say no, because they would have to deal with those other debts. Whether a short sale or a DIL is right for you depends on your market and your situation. Again, an experienced housing counselor or real estate agent is your best guide. The key takeaway is this: you have options right up until the very end. Foreclosure is not a done deal. By choosing a graceful exit, you minimize the financial damage and start rebuilding your life much, much sooner. We've spent a lot of time on the crisis of foreclosure because it's the ultimate way to lose money on your home. But true financial security as a homeowner goes way beyond just making your mortgage payment. Thousands of people who are in no danger of foreclosure are still losing money every single day. Why? Through simple neglect and a lack of proactive planning. Your home is your biggest asset. It's time to start treating it like one. This is about shifting from a reactive mindset, fixing things when they break, to a proactive one. This is how you build real equity and get rid of financial stress. Principle 1. Master the 1% rule for maintenance. One of the biggest budget killers for homeowners is unexpected repairs. The AC unit dies in July. The roof springs a leak. A pipe bursts. These aren't just headaches, they're financial emergencies. A great rule of thumb for this is the 1% rule. It says you should budget at least 1% of your home's value every year for maintenance. So, on a $300,000 home, that's $3,000 a year, or $250 a month, set aside just for upkeep. If you have an older home or live in a harsh climate, you might even want to budget 2 to 4%. This isn't just about having an emergency fund. It's about changing how you view your housing costs. Your mortgage, taxes, and insurance are not your only expenses. Maintenance is a predictable cost of ownership. Budgeting for it turns a potential crisis into a manageable line item. Principle 2. Harness the power of preventive maintenance. Reactive maintenance is waiting for the roof to leak, then paying a fortune for an emergency fix. Preventive maintenance is having the roof inspected every few years and recaulking the flashing for a fraction of the cost. The numbers here are stunning. For every $1 you spend on preventive maintenance, you can save up to $6 on reactive repairs down the line. Think about your HVAC system. Simply changing the air filter every couple of months costs a few bucks and can extend the life of your unit by years. An annual tune-up can boost its efficiency by over 15%. This isn't rocket science, it's just being smart. So, what does a preventive plan look like? It's just a checklist. Monthly, test your smoke detectors and clean your HVAC filters. Seasonally, clean your gutters to prevent water damage. Check windows and doors for drafts and recaulk them. Get your HVAC system serviced. Annually, inspect your roof for damaged shingles. Check the attic for leaks. You can find free checklists for this all over the internet. The point is to be intentional, not reactive. Principle 3. Budget smart for repairs and remodels. Not all money spent on your home is equal. You have to know the difference between a repair, fixing something broken, and a renovation, upgrading for aesthetics, and understand the return on investment, ROI, for each. It's easy to lose money by over-improving for your neighborhood or by picking projects with terrible ROI. The average cost for a full home remodel in 2026 can easily top $50,000. Kitchens and bathrooms consistently give you the best bang for your buck. You can often recoup a big chunk of that cost when you sell. On the other hand, a swimming pool might only return a fraction of what you spent. When planning any project, always build in a contingency fund of at least 15 to 20%. Trust me, you will always find something unexpected, especially in older homes. And speaking of which, never ignore your foundation. A basic foundation repair can cost thousands, but you have to address that before you even think about new countertops. Finally, review your homeowner's insurance policy every year. So many homeowners pay for repairs out of pocket that could have been covered. Knowing your coverage is an easy way to save money. By adopting these strategies, budgeting with the 1% rule, creating a preventive maintenance plan, and being smart about renovations, you actively protect and grow your home equity. You turn your home from a potential money pit into a well-oiled financial asset. That is the true meaning of stopping the loss. We've covered a ton of ground, from the gut-wrenching stress of a foreclosure notice to the long-term strategies for building wealth. If you only take away a few things, let them be these. First, silence is your enemy. Communication is your superpower. The second you think there might be a problem, talk to your lender and a HUD-approved housing counselor. The system is designed to help people who raise their hand. That 120-day window before foreclosure can even start is your time to act. Don't waste a single day. Second, you have options. A repayment plan, a forbearance, a powerful loan modification. These government-backed programs are there to keep you in your home. And even if staying isn't the right move, a short sale or a deed in lieu can be a graceful exit that saves your financial future. And third, stopping the loss isn't just a crisis plan. It's about proactively managing your home like the valuable asset it is. It's about budgeting for maintenance, prioritizing preventive care, and making smart decisions. This is how you turn your biggest expense into your greatest source of financial strength. I know how overwhelming this all sounds. When you're in the middle of it, it feels like you're lost in a maze, completely alone. But you're not. Thousands of people have been exactly where you are and found their way through using the very options we've talked about today. The most important thing you can do is take the first step, and take it now. Time is your most valuable asset. Every day you wait, your options shrink. Don't let fear paralyze you. Let this information empower you. If you're in this situation and need someone to help you figure out your next move, this is what my team and I do. We've helped hundreds of families understand their options and make the best decision for their future. There's no judgment here, only a helping hand. Below this video, you'll find a link to my private contact form and a free downloadable guide that sums up all the options we talked about. Please use it, reach out, let us help you make a plan. You've already taken the first step by educating yourself. Now let's take the next one together. Thank you for watching.